welcome to all our viewers today. On behalf of Bharti Trade Securities and BRS Research, I'd like to warmly welcome you to our second webinar this week on our initiation report on DIPD Products PLC. So we actually have two presenters today who co-chaired the report. Ms. Vaheshi Vategedara, she did the core business segment being the glove segment. So she will take you through the company, the glove segment, the industry dynamics, and also the overall outlook on the segment. While Shalini De Silva, she covered the plantation segment, and she'll take you through the strategic perspective of the plantation companies within DIPD. So as always, we encourage you to ask questions. And if you do have any doubts, please send it through the Q&A box, and we will take it up at the end of the session. So I think without any further ado, I think Maheshi, you can go ahead. Thank you.
Thank you, Nusrat. So good afternoon, everyone. So welcome to our BRS webinar on DIPD Products PLC. We are planning to walk you through the DIPD initiation report, where we assign a buy recommendation under the theme of driving value through capacity and specialization. So before going through the report, let me take you through the investment case. So here you can see we initiate coverage of DIPD with target price of 67 rupees and 70 cents, implying a 29% upside based on today's closing price. So this is primarily driven by 5 key catalysts. First one is operating leverage from underutilized and expanded capacity, and then earnings recovery driven by demand normalization and supply chain management, supply chain realignment, and integrated sourcing and operation efficiencies support margin resilience. And the most important one is the geographic expansion, product diversification, and continuous innovation drive in DIPD products. And those 4 are regarding the hand protection segment, and we have plantation sector, which is the key catalyst is margin stabilization amidst tailwinds. So despite these positive catalysts, we have identified there are key risks as well related to DIPD products, such as input price fluctuations, climate risk, exchange rate volatility, and geopolitical tensions. So we are going to speak about all these things in our coming slides. So based on, after considering all these catalysts and risk factors, we arrived at target price of 67 rupees and 70 cents with upside of 29% based on today's closing price. And in addition to the upside, we expect 1 rupee and 17 cent dividend per share, which has a total return of 31%. So with that, okay. So let me start off the discussion with the business overview. So when it comes to DIPD production, DIPD product established in 1976 is a globally positioned manufacturer of hand protection products. So it operates a highly export-oriented business model and is a subsidiary of Haley's PLC. The business is structured into 2 key segments: hand protection, which is the core earning driver, and plantation sector is there, supporting upstream integration, including listed companies, Kalani Valley, TPL, and Horana Plantation. What I want to highlight here is, although they have 2 segments, those segments operate with largely independent management structures. So if I start off with the hand protection segment, so the hand protection segment is the primary value driver, as I mentioned before. So it operates 7 manufacturing facilities across Sri Lanka and Thailand. So in Sri Lanka, they have 5 manufacturing facilities, and Thailand have 2 facilities. And in addition to that, DIP serves over 70 countries. So they have international marketing and distribution centers across the globe. In Europe, they have distribution centers in Italy, France, and Poland. And when it comes to Asia and Middle East, they have centers in India and Middle East. So DIP products holds around 5% share in the global glove market, and the company focuses on specialized high-value gloves. So they have extensive portfolio with more than 920 product variants, which we can categorize them under supported, unsupported, and disposable gloves. So those gloves are in use across various segments, including household, industrial, and medical use. Yeah. With that, if we come to the second segment, that is the plantation sector. So plantation sector, they have plantation segment includes 3 regional plantation companies, as I mentioned in the first slide. So they with over 26,000 hectares. So it contributes to around 4.4% of Sri Lanka's tea production and 4% of rubber production. So 60% of DIP's plantation sector sales are indirect exports, where tea is sold at the Colombo tea auctions. However, the Kalani Valley plantation has a subsidiary called Mabrock Teas Private Limited, which facilitates tea exports both in bulk and retail pack tea, tapping into the value-added tea category. And while the tea remains dominant, there is a gradual shift towards other crops as well, such as cinnamon, coffee, and spices. So this diversification strategy aims to improve land productivity, enhance export earnings, and reduce reliance on traditional crops. Okay. So that is the brief introduction to what DIPD is doing and what are the business segments they have their presence. So with that, let me take you through the macroeconomy and the industry analysis, how the things happening outside the company impact on DIP products' internal activities. So I'll start off with the macroeconomic outlook. So here we have identified how the macroeconomic factors not only the domestic factors, but also the things happening at international seas, how they impacted on the product's performance. So from a macro perspective, we see kind of mixed dynamics. If we start off with the global macro environment, so global economic growth is expected to moderate in 2026, with GDP projected to stabilize around 2.5% to 3% as due to these rising geopolitical tensions, persistent inflation, and tight financial conditions weigh on momentum. So we have taken these numbers from recent IMF World Economic Outlook. They released in January 2026. So based on that, we factored those things into our forecasting as well. So while the global economy has shown some kind of impact from all these factors, we can see multiple shocks, including geopolitical conflicts and policy shifts, especially in US tariffs, led to this growth softening. And particularly in advanced economies such as US and Euro area, here you can see the numbers. So we, according to IMF, they also believe there will be some moderation in the growth in these markets as well. So we specifically included United States and Euro area here because in coming slides, I will show you how DIP cater to these markets. So these are the key markets of the products. That's why we have included that here. And at the same time, we know that escalating tensions in the Middle East are creating downside risk in the global trade and energy markets. So disruptions to key shipping routes, including around the Strait of Hormuz, have led to supply chain inefficiencies and rise in oil prices, which trigger renewed commodity price pressures. While some of these shocks may be temporary, but they contribute to an increase in the uncertain and fragile global recovery. So if we coming back from global context to domestic context, in case of Sri Lanka economy recorded 5% GDP growth in 2025. So it reflects continued recovery momentum in domestic context. However, still we are being net an important country. We know that we have some exposure to all these external vulnerabilities remain elevated for us. Particularly due to this geopolitical risks. So we believe that will impact on Sri Lanka's external sector performance. And IMF, we can see the progress in IMF program. We received another 2 tranches. We got the approval today. According to our analysis, we believe that if we continue these program, all these measures we have taken, so it will be a benefit in our macro context, and it is important to continue this stability in the domestic context. And when it comes to inflation and cost pressures, of course, as a manufacturing company, so inflation in Sri Lanka has transitioned from crisis-driven hyperinflation to deflation and is now stabilizing towards 5% target level. So, however, there are renewed risks, especially coming from this cost push inflation, especially with these recent energy price increases and global commodity price volatilities. So for DIPD, while local sourcing of natural rubber provides partial protection, still we can see cost pressures are there coming from this energy cost, wages, fertilizer prices, and also the imported raw materials. And also exchange rate is another major factor which impact on DIPD products from macro level. So foreign exchange movements play a crucial role in DIPD's earnings, being export-oriented companies. So as revenues are largely in DIPD, revenues are largely dominated by US dollar and euro. So a depreciation in LKR against those currencies will be kind of a benefit as an exporter. Exporter with this improving export competitiveness and favorable translation effects are not. However, currency fluctuations create certain uncertainties are there also, especially due to mismatches between revenue and cost currencies. So those are the major things which can impact on DIPD products from macroeconomic outlook. And okay, so if we analyze the industry level, so when it comes to hand protection, so here I have put these charts to show you how the segmentation of a glove market happens at the global level. So here you can see the rubber glove market, if we take by type, synthetic rubber gloves are there and also natural rubber gloves are there. So for DIPD, they have presence in both categories. And if we take the rubber gloves market by application, so healthcare is has the major contribution, and industrial, household are there. So again, when it comes to DIPD products, so DIPD has presence in healthcare, disposable glove market as well. Glove market, and on the other hand, they have their presence in industrial glove market with especially their presence in the niche market categories. And if we take the rubber glove market by regional consumption, so this is what I mentioned in the macroeconomic part, the exposure to the euro and US dollar, and also these US markets and European markets. So here you can see majority of the consumption coming from Asia Pacific region, but when we go out from the Asian region, you can see the main market is coming from American region, North America and South America, then Europe, and by the Middle East countries, so Middle East and Africa. So DIPT has their presence in all these regions, which is kind of a benefit for DIPT products. So this is how, in this slide, actually, this is how the industry demand drivers and structural trends happening at the moment in the global glove market. So industry is still in kind of a post-pandemic normalization phase, with demand moderating from peak levels, which we saw during the COVID period. So this however, these demand levels are still remaining kind of high because of increase in the because of increase in the healthcare and industrial safety standards. So that's why, although it's not at peak demand, still we can see kind of a demand for the glove market. So according to industry estimates and based on WHO and also International Labour Organization, including all their insights. So they expect glove market is estimated at around $6.8 billion in 2026 this year, which is projected to grow at 10% CAGR to USD 16.3 billion by 2035. So despite strong long-term demand, the industry is currently facing different cost pressures, especially, and margin compression as a result of that, following this all these geopolitical tensions and oil prices and freight rates have changed, increased. So with all these things, they are facing challenges in terms of cost pressures, especially in this year. So long-term demand is actually supported by structural drivers such as expansion in global healthcare infrastructure, increasing industrial safety regulations, and also in especially in US and European economies, we can see the government's stockpiling their policies. So those are the things we expect to contribute to long-term demand. Also, we can see there is a kind of shift towards this powder-free gloves, which again DIPT has their presence. So demand is increasingly shifting towards nitrile and powder-free gloves, where DIPT Products VS is positioning itself through its biodegradable nitrile product offerings. And also, there is a trend towards higher specification of products. Again, as I mentioned in previous slides, DIPT has around 920 plus product categories, which is a benefit to the DIPT products, hand protection segment. So if I briefly take you through the regional comparison, so actually Asia is the major supplier for this glove market. So regionally, the industry is highly competitive. Therefore, we can see many key players in our region, including Top Glove, Hartlega, Kazan Rubber, etc. So when it comes to competitive positioning, Malaysia is the largest supplier in country-wise. So Malaysian players dominate through scale, automation, and global distribution, enabling cost leadership. And when it comes to Thailand, they are benefiting from rubber integration, supporting cost competitiveness. And when it comes to countries like Sri Lanka, so we are mainly targeting product quality niche segments and innovations. And yeah, so when it comes to Sri Lanka, domestic glove market, I'm not going to dwell too much on this because in case of DIP, they cater, I think, around 1%, maybe less than 1% sometimes to the domestic market. When it comes to Sri Lanka, Sri Lanka's glove industry is highly export oriented in manufacturing angle. So most of them they produce to export, and so we have certain other players which we don't have a pure play glove manufacturers in Colombo Stock Exchange, listed competitors, but there are certain competitors such as Ansel Lanka. So DIP's key advantage in the local context lies in its integrated glove manufacturing capabilities and direct exposure to these export markets, distinguishing it from upstream or non-listed peers. So with that, so that is basically about how the glove or else we say hand protection hand protection segment. So that is how how it is happening right now in global context and domestic context. So with that, let's see how the plantation sector is performing. Over to you, Shani.
Thank you, Maheshi. So with that, I'll move on to the plantation sector, starting with the most dominant subsector, which is tea. And so as you all know, Ceylon tea is a globally recognized name, and it's recognized for its quality and distinct flavor profiles. So within Sri Lanka, tea cultivation happens in three main geographically spread differentiated elevations, namely the high grown, mid grown, and the low grown. So these have their own unique characteristics. And if we look at Sri Lanka's tea production over the past 5 years or so, you can see that the production levels are below par, especially since the fertilizer ban in 2021. That resulted in a significant drop in yields. And although the numbers have improved slightly, it's yet to reach the pre-ban levels. So the consequences have been far-reaching. And so that is the state of the current production in terms of tea. And so how does this tea market operates is that mainly the plantation companies and the smallholders produce this tea, but it's mainly sold through the Colombo tea auction, which is where the pricing mechanism takes place based on the demand and the supply. So this gives very little pricing power to the plantation companies, but pricing is more or less affected by the global supply situation, the currency fluctuations, geopolitics, and so on. So that's yeah. So with that, how does Sri Lanka position itself in the global market? So Sri Lanka, as you know, with these declining production levels, we cannot compete in terms of scale, but rather we occupy a premium niche segment within the global tea market. So if we look at our competitors, the strategies are different. If we look at Kenya and Vietnam, they dominate the bulk segment through cost leadership. Then a market like China will be leading in the specialty teas, while India is more of a diversified player. So international tea prices, however, have been cyclical and displayed some really so in terms of the COVID period, there were some fluctuations, but overall, the prices are depicting a typical a cyclical behavior over the past 5 years with as is in the commodity cycles. So with that, what are the challenges that Ceylon tea will face in terms of the current situation? If we look at the Middle East crisis and the US tariffs. So Middle East is Sri Lanka's largest tea export destination. As you can see, these numbers it's around 43%. So in addition to that, disruptions to the key shipping routes and increased freight and insurance cost, all of that is going to weigh down on the sector. So in the immediate has remained intact. If not, there's been a slight spike in the demand as well, but that is owing to precautionary stockpiling. So that is not something that we can
Sorry for the disruption. I think we have a small technical issue. If you just can spare us a few seconds to correct it, please. Thank you.
internet. Yes, sorry about that connection issue. So I was speaking of the impact from the Middle East conflict. So and moving on from there, the US tariffs. So this is something that will erode the competitiveness of Ceylon tea against low-cost producers such as India or Vietnam. So the top 10 tea export destinations are seen here. So it's dominated by Iraq, Russia, and so on. So US is also in the top 10. So that is also going to be an impact in terms of the local tea production. Yes, so moving on from that, so this is to give an overview on how how the operating environment takes place for tea. If we look at the cost of production, a breakdown of the cost of production, we can see that nearly 70% of the cost of 1 kilo of made tea comes from this labor component. So tea is heavily labor intensive, and that is one of the key factors that is hindering the growth of this sector. So in addition to that, we have the fertilizer, we have the energy and the fuel costs and currency movements, which have indirect impact on the pricing levels. So what we have to realize here is that, as I mentioned before as well, the plantation companies, unless they do direct exports, maybe in premium or niche segments, when they sell, we saw in one of the earlier slides, nearly 60% are through indirect exports. So that is, when it comes to dipped, it's about 60%. So that means most of it is sold through these auctions, and that gives the companies very limited pricing power. But on the other hand, the cost sides is also most of these components are beyond their control. So they cannot pass on these costs in terms of their pricing. And that is one of the key challenges faced by this sector. And I'll quickly give an overview on the rubber and other segments. Rubber is mainly dominated by the smallholder segments, which account for nearly 70% of the total cultivation, and the rest of it is by this regional plantation companies. But there too, we are seeing the same problem. There's a sharp decline in Sri Lanka's natural rubber production over the past decade. The reasons vary compared to tea, mainly the plantations are aging, and a lot of the rubber land has been converted into other profitable crops. So we produce rubber in various forms, such as this RSS or the ribbed smoke sheaths or latex, and the local pricing has moved broadly in line with international pricing, despite certain lags or temporary volatilities. So, as I mentioned, there's increased diversification into other crops or minor export crops or other export crops, and they perform an important role for the plantation sector in terms of diversifying the revenue streams and enhancing the effectiveness of the land utilization. And so one of those key crops is palm oil, which gives a very high yield and comparatively low cost. But the problem is that it's restricted with the policies because, as you know, there is a restriction on replantation of palm oil, so that is a significant barrier to this sector. Then we have coconut. The earnings have been volatile. The production has been low in the recent times, but there is good demand in terms of both the local and export markets. Cinnamon is a very niche segment, high margin. Sri Lanka is known as one of the few countries producing cinnamon. And then there are diversification efforts into other crops such as other fruits and spices and so on. So we spoke of how labor intensive tea is and what are the consequences of that. So plantation sector wage revisions is not something we can skip when we talk about this labor cost. So if we look at the increase in the plantation sector daily wages, there has been several stepwise increases over the past years. So the wage growth obviously has to happen in order to provide a decent living standard for the plantation workers. But the problem here for the sector has been that the wage growth has outpaced the productivity gains. So this has become a large constraint on the profitability of the plantation segment and as an industry, its global competitiveness. So up until about 2021, the wage was decided based on collective agreements between the unions and the RPCs. But in the recent years, we saw more of government interventions in terms of budget proposals. So I think in about 2 or 3 subsequent budgets, there were proposals relating to the plantation sector wage increase. So the issue here is that it's not linked with the productivity improvements. So that is a key constraint. And it not only increases the direct wage costs, but also the other provisions such as gratuity, EPF, ETF, and so on. So just this chart here, what I've taken the numbers of the total wage costs, including the salaries, the gratuities, and the defined contribution plans in relation to the 3 companies that fall under DIPD, TPL, Kalani Valley, and HOPL. So the total of that. So we can see the numbers in terms of the head count has been going down due to various reasons, changes in demographics and the youth moving out of the plantation segments, migrating towards the cities or to other countries, looking for greener pastures. So the headcount has been coming down, but the total wage, the wage per employee has escalated. So there is an inverse relationship between the number of workers and the cost per employee. So this is quite significant to highlight that, and the cost pressures will remain upward biased unless successfully it's linked to a productivity linked wage structure. So yeah, here I've included some listed peers of the plantation sector and how this how the dipped plantation companies or TPL, Kalani Valley, and HOPL ranks in terms of the valuations. So the prices are as of 31st March. So there may be slight variations in terms of that. But overall, the trend remains more or less the same. So TPL and Kalani Valley, if you look at their multiples in terms of PER and PBV, they trade at lower multiples, and that is somewhat that has been the case in the past years as well. But HOPL trades at a slightly higher multiple. But in a way, we could justify it because HOPL's earnings are more diversified compared to TPL and Kalani Valley, where it's more based on tea. But HOPL's earnings profile has some exposure to palm oil as well. They have about 250 hectares of palm oil. So in terms of revenue, still it's not as significant as the bigger players who are into palm oil. And even the extent is much smaller comparatively. But however, so you can see that even though HOPL trades at a slightly higher multiple, it's still lower compared to the likes of Vatavala, Namunukula, LPT or Galavatta. So in terms of those, still it ranks lower because the exposure to palm oil, although there is a good diversification and an income stream from that, the exposure is still limited. Yes. So with that, we can move on with the investment thesis for dipped products.
Thank you, Shani. Okay, so let's see how based on what positive catalyst we recommended you to buy dipped products PLC. So I'll start off with the catalyst related to hand protection segment. So when it comes to hand protection, the first catalyst we identified here is the operating leverage from underutilized and expanded capacity. So what's important here is that DIPD has already done the heavy lifting in terms of capacity expansion. So with the Highcat Thailand acquisition, which they had last year, they increased disposable glove capacity by about 60%. And at the same time, they expanded their Hanwella and Kottawa facilities to focus more on higher value products. And this means they now have the capacity in place without needing immediate additional investment. And currently, here you can see the utilization, capacity utilization rate is around 80 to 90%. So there is, we think there is still room to grow. And as demands picks up, this should translate into stronger margins because a large portion of their costs are fixed. So now in the near term, there could be some pressures due to these geopolitical issues and trade disruptions, and which may temporarily affect utilization, that may affect demand as well. But over the medium term, as demand normalizes, we expect them to fully utilize this capacity and unlock the earnings potential from these expansions. And the next next catalyst we identified is earnings recovery driven by demand normalization and supply chain realignment. So the global glove industry is now moving out of post-pandemic correction phase, which I mentioned in our industry analysis and the macro part. So during 2022 and 2023, the industry faced excess capacity and high inventory levels, but by late 24-25, these inventories, especially in key markets like US and Europe, have largely normalized. So this means to DIP products is that the company is now seeing a gradual return of order flows and better demand visibility. And for DIP, this is a key thing. With demand normalizing, the company can improve capacity utilization and generate more stable and predictable revenue. So importantly, DIP benefits from their exposure to both medical and industrial gloves. While medical demand is stabilizing, the industrial segment, driven by construction, manufacturing, chemical sectors, also they have their presence in sports, so which provides a more resilient growth path according to our analysis. So on top of that, US tariffs on Chinese glove imports are shifting demands towards other Asian producers. So now they have kind of a flat rate, but when it comes to Chinese market, we believe that with all these tariff changes and the uncertainties are there is more chance to other Asian manufacturers in the US market. So overall, this sets the stage for recovery in earnings and industry returns to more balanced conditions based on our projection. And the third one is the integrated sourcing and operational efficiency support margin resilience. So one of DIP's key strength is its raw material source strategy. So around 60 to 70% of natural rubber is sourced from locally through smallholder networks, which reduces dependence on imports and improves supply reliability. At the same time, they maintain some levels of imports, giving them they have some levels of imports. So on top of that, there is a RSS3 pricing mechanism which helps anchor the domestic rubber prices to global levels. So this gives better cost visibility and helps manage input price fluctuations more effectively in DIP. And operational efficiency is also a major focus in DIP products. So the company has restructured recently their France operations, which they have a distribution center operations in to improve the cost efficiency, and we are already seeing early signs of how the cost efficiencies are improving in DIP products. And in addition to that, DIP has invested in automation through robotic plant and enhances consistency, reduces manual dependency, and improves overall productivity. So they also have, in terms of energy costs, they have about 20% of their power comes from renewable sources, which helps to reduce exposure to volatile energy prices. So overall, these initiatives, we believe that will support stronger cost control and margin resilience over the longer term. And okay, the fourth one is the geographic expansion, product diversification, and continuous innovation drive, which can sustain the growth in long term. So this is another key aspect with regard to DIP products. So here you can see how they present. They have their presence globally. So they have their presence in North America, South America, Asia, Africa, Middle East markets, also in Europe, Australia, New Zealand. So they have their presence around the world. So the company operates across more than, they cater across more than 70 plus countries with including all the regions, as you can see here. So the majority of their their top line is coming from European market, which is around 54% based on the recent financial statements, based on the last year of FY25 financial statements. The second the second largest market is North America with around 19% contribution and South America with 11%. So here you can see altogether in American market they have more than 30% present. And in Asia, Africa, Middle East, they have around 30% contribution to the top line. So here, this is why I spoke very less about the domestic glove market. Here you can see to the local market, they provide only 1%. So on the other hand, they have diversified portfolio of their products, which they have ability to cater to the different market segments and different industries. And also all these differentiations, value additions are further supported by continuous investment in R&D, which allows them to innovate, customize products and meet evolving customer needs, which we discussed in the previous slides in the industry. When we discuss about the industrial analysis, I told you what are the trends in the global market, glove market. So these diversifications and the R&D help them to cater to those markets, those demands. So that is, we identified this as a key catalyst, therefore. Okay, so those are the four catalysts related to hand protection segment, which contribute around 60 to 65% of the top line. So this is what we think the rest 40% we expect it to driven by this plantation sector, tailwinds and margin stabilization drivers. I think Shalini gave you a good explanation about the industry. And so here you can see, looking at the plantation segment, there are a few key supportive factors. First one is the depreciation of Sri Lankan rupee actually works in favor to plantation companies, although these DIP doesn't have, apart from one subsidiary under Canny Valley Plantation, although they don't have direct exports, it is I think it is a benefit to the overall plantation segment, plantation companies, especially engage in exports. And secondly, we are seeing the gradual shift towards diversification. So companies are increasing their exposure in minor crops like coconut and cinnamon and other spices. And finally, on the cost side, the plantation companies are taking steps to manage rising costs, especially after these wage increases. So considering all these factors, despite the cost challenges, we believe that there are tailwinds supporting the plantation segment. Okay, so with that, since I explained you all the key catalysts, why we are telling you to buy DIP products, let's see our financial analysis in terms of numbers, why we tell you to buy DIP products and our valuation. So in this slide, I'm going to tell you the revenue, cost structure, and the margin. So starting with revenue, DIP is primarily driven by hand protection segment, as I told you in previous slides. So around 60 to 65% of total revenue, with the remainder coming from plantations. So within hand protection, growth is less about pricing. It is more about capacity, utilization, and product mix, as per our analysis. So the company is strongly positioned in industrial gloves, and we have seen good growth, around 30% in FY25 in the industrial segments, supported by new customer additions and global demand. Another important point is the demand is relatively, I'm referring to hand protection segment, not the plantation segment. So in hand protection segment, actually, if you take numbers, you can see important point is this demand is relatively non-seasonal. So, if you take the customer satisfaction numbers during last few years, the number is high, which helps with retention and gives better revenue visibility according to our analysis. So that's about revenue. And on the cost side, the business is heavily driven by here I have given you the breakdown based on what they are publishing. So here you can see the majority of the cost is coming from cost of sales, around 60. Majority is coming from cost of sales. So under cost of sales, the natural rubber being the biggest component, around 60%. And the rest comes from processing costs like chemicals, energy, and labor. So naturally, margins are sensitive to raw material prices, that is natural rubber and other raw materials, although this is partly offset by local sourcing and efficiency initiatives. So below that, at operating level, we have distribution cost, which is quite low, around 3% of the revenue, and other operating expenses are there, about 11%, reflecting a fairly efficient cost structure for as this is a global business. So when we talk about cost structure, I want to specifically mention about the natural rubber. So natural rubber is a key input. I said it is contribute to around 60%, 70%, 60% of cost of the sales, and from that, what they source, again from 60 to 70% is sourced locally. So while this improves supply reliability, it also depends on factors like domestic weather conditions and smallholder dynamics. So there are also certain operational challenges in this when sourcing the natural rubber. For an example, according to what we learned, smallholders, there are some smallholders who prefer immediate cash payments or to certain things like that. They prefer immediate cash payments likewise. So DIPT has taken several measures to manage these challenges, but still there are supply constraints there. So I think I spoke about RSS3 mechanism, which guide the prices of natural rubber, which is linked to global rubber prices, helping to provide some stability and visibility on input costs. And in terms of margins, gross margins have historically been stable around 21 to 24%. Here you can see. However, we do not expect them to, when it comes to FY26, of course, we expect to continue that trend. But when it comes to FY27, we see some pressure due to this geopolitical tension, especially on margins. So we expect this pressure in at all levels: gross profit margin, EBIT margin, and NP margin. So when it comes to EBIT level, operating level, margins have averaged around 11%. And however, again, we expect a temporary dip in this year, FY27. So overall, while there are maybe short-term pressures, but in long-term outlook, we remain positive, supported by this demand recovery, better utilization, and ongoing efficiency improvements. So this is just to show you at a glance the key ratios, how we expect company to perform. I think I already spoke about profitability ratios, so I'll move from income statement to balance sheet side. So on the balance sheet side, here you can see the gearing ratios, debt to equity ratios. We expect them to improve over time with the debt to equity trending downward, and interest coverage ratio also to remain comfortable in overall. And dividend payout, if we payout ratio also it is typically low. Even if you see the past trends, you can see typically compared to other companies, it is somewhat low. So, however, we expect to continue that trend. We are not seeing any significant increase in payout ratio. So, we do not recommend DIP as a dividend player here. But still, we expect some payout to continue the payout. So those are the things I want to highlight in under key ratios. And with that, let's move on to the valuation. So here you can see we value DIPT using sum of parts valuation, where each segment is valued separately. So we valued the hand protection segment separately based on DCF valuation and the plantation, three major plantations as well. So hand protection segment, which is the core business, is valued around 41.9 billion here, you can see. For the plantation segment, we value each regional plantation company individually, Kalani Valley, Talawakale, and Horna Plantation, also using DCF valuation, which bring in total firm value to approximately 51.2 billion. So with that, we have given intrinsic value per share of 67 rupees and 70 cents as per FY27. This target price. So based on, sorry, I couldn't change the date here. Actually, this should be yesterday's date. So this is today's closing price is 52 rupees and 50 cents. So based on today's closing price, here you can see 29% upside. So when we released this report, we had around 37% upside. Now it has come down to 29% with the appreciation of the market prices. So here you can see the assumptions we have taken. So under the assumptions, I want to mention one thing about the cost of debt. So the group's cost of debt reflects a blended rate across domestic and foreign currency borrowings. While the local loans are priced at AWPLR linked rates, the group also have some lower cost foreign currency facilities. So considering all these facilities, we have taken a cost of borrowing approximately around 6.5 to 7% in our valuation. And so apart from our major valuation, we have based on SRTP, we have done this market-based valuation also. In addition to that, so here we have used PER and EV to EBITDA. So starting with PER, here you can see we arrived at 64 rupees and 70 cents target price based on PER valuation, and on EV to EBITDA, based on EV to EBITDA valuation, we have arrived at 70 rupees and 50 cents target price, which both gives you 23% upside and 34% upside respectively. So what's important here, I wanted to highlight here is, so here you can see overall the market-based valuations also support the idea of potential re-rating as earnings recover and company moved towards more normalized conditions, even though we are seeing short-term pressures. Okay, so with that, let's see how we valued plantation segment. So what do you, Shalini?
Yes, so I will briefly take you through the valuations of the three plantation sector counters as well, starting off with Kalani Valley plantations. So for all three companies, we followed a blended method of DCF and price to book value. And for Kalani Valley Plantations, with that, we arrived at an intrinsic value of 88 rupees and 85 cents. So the upside was around 11.8% on 31st March prices, and based on which the individual rating for the company is a hold, because we have a benchmark of 15% for our buy recommendations. So for Kalani Valley, we believe the diversification in the crop mix and the elevations stand in their benefit, along with the opportunities in terms of market expansion. And weather-related volatilities remain a key risk, along with the cost pressures and the wage cost escalation, which affects the entire industry. And in addition to that, Kalani Valley has an exposure to the volatility in the rubber prices as well. And moving on to our next plantation counter, which is Talawakale Plantations PLC. So there we have arrived at an intrinsic value of 163 rupees, an upside of 26% on the 31st March prices. And here we believe TPL has been one of the most consistent performers in the sector, and there is a very strong exposure to the high-grown tea, which generally commands very stable pricing, and resilient margins are possible due to their premium pricing despite the cost pressures. So the risks remain the same as I spoke earlier for Kalani Valley as well. So more or less the risks those are similar in terms of the plantation sector. And however, we position Talawakale as one of the key players in the sector, especially in the listed market. And with that, we move on to Horana Plantations. Horana Plantations, we have arrived at an intrinsic value of 56 rupees and 75 cents. This is more of a diversified plantation play. There are multiple revenue streams which diversifies their earnings, and the exposure to palm oil, although limited, still offers a better potential in terms of margins. And what we forecast as well is for this contribution from the diversified crops is to increase over time. And the key risks that come with that is the high exposure to this rubber and these other crops poses a great volatility in terms of earnings, especially rubber earnings has been volatile over the years. And other than that, it's the cost pressures in terms of the wage escalations, the climate changes, and so on, which are common to the industry. So those are the three counters, the valuations in brief. And of course, if you go through our report, you can go through the valuations and the catalysts and the risks in greater detail. So that brings an end to the valuation of the three plantation sector counters. And we can move on to the key risk drivers for the group.
Yeah, so I think before we conclude, it's important to highlight the key risks. So the first one is the geopolitical and trade disruptions, which remain as a major concern at the moment, especially given the Middle East tensions, which impact on our overall trade of Sri Lanka. So if we talk about specifically on Middle East tensions, so that act as a key risk factor for DIPD, impacting both global demand conditions and domestic macro stability. So from a cost perspective, we could see higher freight and input costs along with shipping delays and rerouting, which may put some pressure on margins and delivery timelines. So on the demand side, uncertainties can be there in key export markets, which could lead to temporary delays maybe. Particularly, we see this impact coming in not in the first quarter, this March quarter, but in the coming quarter. Not in the first quarter, but in the second quarter and third quarter of FY27. So, in addition to that, currency volatility arising from reduced foreign inflows may increase earnings fluctuations, although a weaker LKR could provide some translation gain for export earnings. However, I think there are several measures DIPD has already taken to mitigate these risks. The company operates on a make-to-order model, which helps minimize raw material inventory risk and avoids excess stock build-up, and stronger customer relationships are there, which is allowed for advanced ordering, which can partially offset shipping disruptions. At the same time, DIP benefits from a well-diversified export base, which can reduce their reliance on any single market. There is also a natural hedge through export earnings, which helps to manage foreign exchange risk. And finally, the companies establish supply and logistic networks, including contracted fuel and LNG supply, support operational continuity with minimal exposure to these expected fuel shortages, I would say, although we are not seeing any cues so far, mainly. And when it comes to second risk, that is the raw material price volatility, of course, there can be, if there is any volatility in natural rubber prices, as I mentioned, so since it is the major material, the key material, there can be direct impact from that. Apart from that, there are chemicals and other imported raw materials are there. So if there is any price volatility in there can be impact on cost. And the third one is the climate-related risk. Of course, since the key material is rubber, natural rubber, if there is any weather changes, that can impact on our supply chain. Also, foreign exchange volatility as a key risk is there. DIPD is a heavily export-oriented company, so definitely they are facing other exchange rate volatilities. And in addition to that, there are so the last three is mainly related to plantation sector. So if there is any structural increase in the labor cost, that can impact on plantation sector, which could pressure margins. And another important fact is limited pricing power. So especially in plantation operations where prices are driven by auction mechanism. And finally, production and yield constraints in plantations can affect output and overall profitability. So that brings us to the end of our presentation, and thank you for your time. And we are happy to take any questions.
Thank you. Thank you so much, Mahesh and Shalini. I think you covered most of it in a very comprehensive presentation. To our audience, if you do have any clarifications or questions, please keep it coming in using the Q&A box. But just to start off with, Mahesh, a question. So we did during the COVID see that margins were unusually high. I think you showed it in your slide as well. So now it has pretty much normalized. But going forward, where do you think these margins are heading? Is this the new normal, or are we going to see the margins increasing over time? That's the question.
Yeah. So yeah, I'm modified. So when we talk about the peak demand during the COVID, if you go through the historical numbers, you can see the COVID margins were exceptional and they were actually not sustainable. So, however, we do not expect margins to improve from current levels despite the projected, we expect margins to improve from current levels, despite all these short-term cost escalations, especially as I mentioned in the previously under the risk. So we see some pressures in the second and third quarters of FY27. But going forward, we see these things will normalize and product mix is there, which can shift towards the evolving demand. So rather than peak levels, I would say we are looking for a healthier and normalized margin profile going forward. So yeah, if we compare with the COVID period, we are seeing more healthy and normalized margin profile. Hope I answered your question.
Yes, Mahesh, yes. And I think there's a couple of other questions coming in from the audience. So the first question is, are there any growth plans for the company, like new verticals to explore?
Hope you are referring to the plantation segment. So actually, about the new expansion plans, I think they are not in a position.
Mahesh, I think this question is for, I think, both, maybe the gloves and the plantation, both sectors.
Okay, I'll answer for the glove segment. In terms of glove segment, hand protection segment, so I don't think they are in a position to publish all the expansion plans right now. So I think they are looking for expansions. They have ability to expand certain areas. I think what they acquired in Thailand, Haikia, that in that area also they have more space to expand and they have some expansion plans. But I don't think to answer to your question, I think I'm not in a position to tell you any new expansion plans. But yes, if I can get back to you with anything which they can publish, I'll get back to you.
Okay, thank you, Maheshi. Shalini, there's a question for you. In terms of the cost in the plantation sector, so we know the plantation sector has always been a dilemma due to the structurally rising costs, especially for labor and input pressures. So what are your thoughts on the current cost levels? Do you see this business is sustainable going forward?
Yes, so I think especially in the last few years, this wage hike, even to this extent, it was sustained because of, especially after COVID, we saw some good prices being fetched by tea and so on. So unless the prices are able to support this cost structure, it's not going to be sustainable, I would say. So we'll really have to look at, and the productivity levels is the other factor. So we'll really, the way forward would be to link this with the productivity, so that along with the increase in cost, we see an increase in the level of productivity as well. Otherwise, this is not going to be sustainable, especially for a labor-intensive crop like tea. That is going to be definitely going to be a challenge.
Okay, thank you, Shalini, for that. And Maheshi, again, over to you. So we know, and I think you also spoke about DIP moving into the premium gloves segment. So there was a lot of talk before also as well. But in reality, do you see customers actually paying more for premium gloves? Or is it just about protecting margins rather than expanding them?
I think based on the industry information available, so rather than whether they are willing to pay, the standards in the industries, not only in healthcare segment, in the other industries, so the standards change, especially with the International Labour Organization. They have changed certain certain criteria. So that is why we can mainly see this demand coming from niche markets and these premium market. So when it comes to DIPD, of course, that's why I think that's why they are targeting those markets. And if we yes, if we compare with the disposable glove market, the margins are comparatively higher. And also, I think, especially if we take the global market, for countries like Sri Lanka, it's important to focus on niche markets, premium markets, because there are a lot of supply coming to the more competitive products from China and also from Malaysia. There are top players in Asian market like Top Glove. So I think that's why to sustain in long term, I think it's more important to focus on niche market.
Okay, thank you, Maheshi. So one more question to you, Sharini, on crop diversification. So often we hear that crop diversification is a potential risk mitigant. But in practical terms, how do you see this diversification strategy? Can it actually help in smoothing earnings going forward?
Yes. So at least in the near term or the medium term, this is not going to fully mitigate the risks, but at least it could bring a partial hedge. That is why we see increasingly the plantation companies are looking at diversification. They're looking at more commercially viable crops and so on. So immediately it may not be able to fully take up the space that was occupied by the key crops such as tea or rubber. But definitely it will help in mitigating the risk. Now, if you look at palm oil, it is a far less labor intensive crop and is more profitable. The impact of wage increases is not going to be as severe as felt by tea or rubber segments, and even this other spices and cinnamon and so on. So those are more of niche segments that can command some premium pricing. So on the other hand, so these commodity prices also will be linked to the global demand and the global commodity cycles. But definitely it will help in reducing the concentration risk, and it will eliminate some volatility from the earnings.
Thank you. Thank you, Shani, for that. So one final question to you, Maheshi. So if you look at DIP today, if you consider DIP today, would you say this is more of a recovery story as the cycle improves, or something that can deliver a very steady long-term growth looking at it now?
I'm sorry. Can you hear me now?
Yes, Maheshi, yes. Go ahead.
Yeah.
Did you get the question? Yeah.
Yes, I had the question. So at this stage, it's primarily with the current cost pressures we are seeing. In short term, maybe they are looking at some recovery given the current cost escalation, especially from this due to these pressures on global trade. However, the shift towards specialization and capacity optimization also provides a longer-term growth angle. So, with the heavy investments in R&D and capacity expansions, which reflect long-term growth. So, it is, I would say, it is kind of a combination of.
Okay, so I think that brings us to the end of our presentation today. I'd really like to thank everybody for joining in for this presentation. It will be uploaded to our SRL website, so if anyone has missed it, you can go in, log in and watch it. Your feedback is very important to us, so please keep it coming in through your advisor, or you can even email us at research@bharti.com. So on behalf of Bharti Securities and BRS Research, thank you very much for joining in and have a pleasant evening.